Looking at your stock price today at 1.3%, I know that's not everything, but talk to us about the future. You had a good quarter in the past. Many are worrying you can't sustain that sort of growth.
Yeah, so we had a great quarter this quarter. Just in some specifics, we generated $6 billion of net income. Our return on equity was north of 12%. Revenue was up, expenses were down. Credit, as you mentioned, was very strong. And there's a variety of signs of momentum, some of which have been missing for a little bit in some of our consumer lending categories. So all of that actually was very strong for the quarter. On a go-forward basis, there's a combination of things for all banks, maybe for Wells Fargo in particular. I'd say banks are valued as the price-to-book multiple that generates stock price is a reflection of the relative ROE of every bank. If you plot it out over the last several years, there's a very straight line that goes through the locus of points. And many banks that have pulled back, even in spite of what looks like pretty good results, have been above that line for a period of time because people had even higher expectations built in for what their future ROEs might be. And the banks, including Wells Fargo, that have been below that line will be below that line until the stock gets bought back up to it because we deliver against sustainable ROE outcomes or we otherwise convince people that ROE isn't at risk. But there really is a very clear connection. It's about delivering return on equity, which comes from revenue growth, it comes from expense control, it comes from controlling the denominator. We returned about $9 billion worth of capital this quarter, which is part of that calculus as well.
John, let's drill down a little bit into some of the consumer side of the business, because we did see a little bit of weakness there in loan growth. I'm also curious as to what is going on specifically with some of the credit card businesses and the point of sale growth in that area.
Sure. So in payments, in point-of-sale payments, so we're a bigger debit card issuer than a credit card issuer. We're the biggest debit card issuer in the U.S. We had 9% growth in year-over-year payments in the third quarter from debit card and 7% in credit card. So I think it's an expression of a lot of vibrant consumer activity, which is contributing to the strong overall growth that we're having nationally. With respect to credit card, in particular at Wells Fargo, we're relatively under-indexed. We probably have $50 billion worth of credit card debt and $30 billion of that being core general purpose. We launched a new product this summer called Propel, which is a very attractive product from a no-fee and high rewards perspective. So we would expect to grow faster there than the average bank who's already fully indexed in that way.
John, when it comes to thinking about rates, you often hear it sort of goes in two directions. So some people say the economy is really good, and that's what's driving up rates. Or people say rates are going up, and that's a threat to the economy. Which of those framing of the rates picture makes more sense from your perspective?
Yeah, well, so it depends on which end of the curve you're talking about. So the policy rates, which are really driving, immediate bank earnings, et cetera, and are making, I think having a bigger impact on asset prices because people fund risk assets with short-term funding. They have an immediate benefit, and they're reflecting, as we've all talked about, the Fed's perspective of getting back to a normalized level above 3% based on how deep we are into the cycle. Further out the curve, we had flattening for a period of time, and then it's gotten a little bit less flat, I suppose, as we've gotten up to, call it 3.24 or 25 in the 10-year. It's not that high any longer. But what happens there, or what's happened over the last few years, is every time we've ticked up above 3%, and now we're somewhat above that, there's a lot of buying occurs, including buying by banks, incidentally, because one of the things that's been missing in our earnings calculation or our earnings capacity over the last few years is parallel shifts in the curve, because as it got flatter, when we generate excess cash, including just reinvestment of amortization, principal repayments, and maturities in our bond portfolio, we had been reinvesting them at those lower rates, and now we're reinvesting them at somewhat higher rates. So perversely, there's a benefit there.